Hi, I'm Tom Swan, a partner in the corporate finance team at Shepherd & Wedderburn. In this episode of our series, we're going to cover the Waterfall provisions, or return stack. What do these provisions do? In essence, they set out the entitlements of the shareholders to equity returns other than dividends. The most important of these is a sale of the company, where the stack determines each shareholder's share of the sale proceeds. The provisions continue to provide for investors who hold Series A shares to receive a participating preference on their shares. This means that they will be entitled either to receive their money back or a multiple of their money back before ordinary shareholders receive anything, or to have their shares treated as ordinary shares and so participate in the total proceeds pro rata with the ordinary shareholders. However, the changes to the provisions mean that Series A shareholders don't have to choose which option to take. They will automatically be given the one under which they receive the most cash. The provisions also now cater for non-cash distributions, and optional wording has been included which is intended to allow UK, EIS and VCT investors to hold Series A shares which have a participating preference and retain their beneficial tax treatment. If used, this wording will mean that corporate shareholders who hold more than 50% of the shares in the company will have their economic and voting rights capped at 49.99%. To wrap up, the return stack is always a really important point for investors, even more so in the current environment of lower valuations. So these provisions will continue to be the subject of discussions with founders in negotiations on deals. To learn more about the changes, please see the link in the description.